Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and also known as the Options Guy. So they did it. At least it appears that way. They kind of did it. They kicked a can further down the road, which will help out the people of the United States of America. So Congress was able to stop wrestling with each other and pass a bill that delayed the budget, or that actually delayed the shutdown of the government and gave them another 45 days to negotiate the budget. But in another 45 days, we're probably going to be right back to where we were again. So on Friday, in anticipation of that, one of the things that we did notice was that the VIX index was trading right around 16. It's almost appearing that they knew that that Congress was going to pass something, which it was really close. If you followed the news over the weekend, a lot of people don't, but if you did, notice that there were a lot of things going on in Congress. To be a fly on the wall during all of those sessions. And well, I'll just leave it there. I don't want to get too political on things across the board, but they signed something into law to prevent the government shutdown. And that's all that really matters. Is the one function, and I will say this, the one function of Congress is to fund the government. And I don't know why that has been such a hard task recently, but that is their one and main function of government overall. So they were able to do it for another 45 days, and then we'll be back to where we were. And we put this VIX trade on in anticipation that they were not going to be able to pull off a funding bill or budget, or however you want to say it, and saw the VIX trading right around 16, which wasn't even really a scary level as far as the fear factor is concerned. I would almost call that just normal volatility. Recently, the VIX has traded as low as 14, down to even the 13 level. And so being right around that 16 level was not showing any hint that the marketplace was afraid of what might happen on Monday. Well, the VIX was right, but going into the close, it did creep up, and we did have a down market on the open today. So because of that, our trade is still doing just fine. So I want to review that trade. And also I had from my screenshot, I saw that I had an error in the way that the initial trade was set up. And we were saying it was a net debit of 5 cents. The net debit was actually 25 cents, which makes a little bit more sense in general of doing the trade. But let's set up that trade and look at it. And at this point in time, because we've got another 45 days and we're not going out 45 days on our VIX options, I would just look to close the trade. Now, we'll give you a couple of options on that trade, but there is a profit on it, and it's actually not a bad profit overall on the entire trade. But we now see the SPX today is down for about 0.1%. The VIX index actually was up a little higher. It's trading at 1783. When we put on this VIX trade, like I said, the VIX, well, I can give you the exact numbers. I actually wrote it down. The VIX was at 1633. We're now at 1779. And it did creep up a little bit higher than that. But once again, when you're looking at the actual VIX index, that's not what drives the option contracts that go out further in time. It's very important on the near-term option contracts, but on the further you go out in time, the futures, the VIX futures contract for that expiration is what really drives the put and call prices on that VIX option chain. So October 18th is the expiration that we chose. We did that on purpose. We wanted to give a little bit of leeway, a little bit of room going out into October. September, once again, underperformed the marketplace like it always does. Everybody has high hopes, but it seems like September always manages a way to come in negative for the month. We are in October. This Monday, to me, was a very scary Monday. And I'm excited about the fact that they were able to that Congress was able to kick the can down the road another 45 days, because I really did not think that was going to happen over the weekend. weekend. I just had no faith in their ability to do that. So let's hope that they can get to a conclusion in the next 45 days. Economy's on a little bit. The economy's been doing extremely well relative, considering what's going on with the Fed marketplace and what has actually happened in the Fed. And I'm going to pull this up and show it to you a little bit later, not right now though. But let me take a little peek over here in that the Fed Watch tool, which I usually want to check out every Monday at the very least, if not more often. But the probability of a 25% raise in November 1 week ago was all the way down to about an 18.5% chance. So in their November meeting, the probability of them, the Fed actually raising the Fed funds rate 0.25% was all the way down to about 18%. Now, to let you know, prior to their most recent conversation that they've had, there was about a 40% chance that they were going to raise rates in November. So now I look at it this morning based off of some of the economic data that we've received, maybe even today, and some of the other conversations. I'm sure that the budget talk conversation has something to do with this. We now see that the Fed funds rate is up around 30%. Now, if the government shuts down, that's going to be bad news for the economy. The last time around, when we had a government shutdown, I even made a little note on this. Let me see where this is at here. 1 second. I found it to be interesting, so I made a note. So the big shutdown was 34 days, and it was an $11 billion hit to the economy. So effectively, it might hurt the economy enough that the Fed doesn't want to increase interest rates, but now we see it right around that 30% level, which means that's still a good chance. That's a pretty darn good chance of them raising rates in that November meeting. All right, so now let's run to the TradeHawk software and let's look at the options grid and look at these VIX trade. And then we're going to talk about a bunch of paper trades today. And once again, it's just really hard for me to get long the market at this point in time. If anything, we'll talk a little bit about the Costco trade that we put on, and kind of getting ready maybe for the Christmas holiday season, the shopping season, Thanksgiving, Christmas, Black Fridays, all that good stuff. And we got an Amazon Prime Day. They're going to have another one in October that's going to be coming up. So I guess as that may be considered a holiday. I'm not quite sure. At least Amazon would like you to think that it is. The government one, because they're suing them for trying to become a monopoly in that range. And that's specifically what they're targeting, the actual retail space, which Amazon's doing way, way more as far as the cloud business and AWS and acquisitions that they're making in that space. So it's befuddling. Here we are, VIX index. 1782 is where we're at today. We went out to the October 18th expiration. We had the VIX right now trading right at 18. So inside the TradeHawk software highlights the most at the money option contract. On this side of the screen, we have calls. On this side of the screen, we have puts. Talked about Russell Rhodes and the great Options Guy TV that we had with Russell and great interview that we had with him. And he talked about this being his favorite trade. So I jokingly coined it the RR, which is obviously Russell Rhodes' initials. But the trade was, we're just going to sell a put option. I should say, let's say it this way. We're going to sell a put spread to help pay for an out of the money call. So this was the specific trade that we set up. We sold the 15 strike put, bought the 13 strike as protection, and then used whatever credit that we received from selling the put spread to help pay for an out of the money call. And when it was all said and done, the out of the money call was trading for about 50 cents. And and we brought in and we paid a net debit of 25 cents. Well, with the credit, the total cost of the trade was about 25 cents. Now we do have risk. I always want to point that out because that put spread has risk at expiration. If the market is below 13, you could lose an extra $2 on this trade, plus the net debit that was paid for the trade. So $2.25 was our max risk on the trade. At the very least, we wanted the VIX to stay above 15 on the October 18th expiration, which the VIX always stops trading the day before, and the settlement is determined on the open on a Wednesday, October 18th. Okay. Now we see that this call option is up. And part of the reason why is that we saw the VIX, the VIX of the VIX, the volatility of the volatility index is at 94. I made note on Friday's show that it was trading right around 88. So we had a 16 VIX and we had the VVIX trading at the lower end of the range, down around 88. You know, the VVIX, I say in general, is usually around 100% implied volatility, but recently it's been trading under 100%. So we got a increase in volatility on the 30-day weighted average in the VIX. And then we also had just an increase in the spot price in the actual VIX index. And so the 21 strike is actually up a bit. It's trading at 67 by 63. So you're profitable on the long call if you wanted to sell that. Like I mentioned before, it was trading right around, I'm going to take a quick peek, around 55 cents, 54, 55, right in that range. So then if we look at this entire trade now, we paid a net debit of 25 cents for the trade, but we did have a margin requirement of $2 for that short put spread. And now it's trading at 52 cents. So you could sell this for 52 cents if we flipped it all around. We made this a buy, this a sell, this a sell. It would be a net credit of 52 cents and you'd be up 25 cents on that trade. I would do it. The event that we were trying to target didn't happen. The can got kicked down the road. The marketplace is still not necessarily happy about what happened over the weekend, but it appears that they don't mind. We see most of the major averages trading flat today. So at this point in time, the way that I would enter this trade, and I'll just do it right here on the TradeHawk software. This is a paper trade, so I don't have that position on inside this test account. But this would be a buy to close, but we're going to click buy to open only because the position's not on in this account. And we got a buy to open. That would be a sell to close. And this buy to open would be sell to close. And right now we see the midpoint would be a credit of 43 cents. And that's what would be sent to the trading floor. Looks like we lost 7 cents in during my explanation. But I would just get out of this trade right now and move on to the next trade. I don't think it would have been bad to maybe just sell the long call and stay short the put spread. But I would prefer to just get out of this trade because we had a plan. Our plan was we were anticipating that the government was probably going to be shut down on this Monday and what that might do to the marketplace. And thank goodness that it was not. And that happened. Okay. So we've talked about a lot of trades in September. It was dicey markets. So I want to go and actually kind of mention a few of these trades. It was hard to get long anything in September, but we did on Caterpillar. And I want to highlight the fact that in our paper trade on Caterpillar, let's just actually go look at the chart because I didn't write down where I bought it at. So if I bring up Caterpillar, we've had a strong move to the upside more recently in Caterpillar, and we did a fig leaf trade, and not that long ago we had a call that expired because we did buy the long option contract and sell the short call against it, which is considered the fig leaf. And if you zoom in, we actually have had a very choppy marketplace, but we've been selling calls against this position. But we do have the 50-day approaching on the 20-day, which is a good thing. And we have a fairly solid up day in that position. Keep selling calls, keep doing what we're doing. Nothing real wrong with that scenario. And if you look at the one big thing that we would like to do is kind of see a breakout through this little gap down all the way up towards that 280 level and hopefully to infinity and beyond, if you will. Okay, so now if we go back and look at Costco, the trade, when we put this on was at 562, and once again, just getting long retail going into the holiday season here. It went from 562 up to 568, so that trade is doing fine. We also looked at doing a fig leaf in that underlying. And then in the Jets, we saw rising fuel costs. So we got bearish in the Jets index, which covers the airlines. It's an ETF that covers the airlines. And that underlying was trading at 1807. It's now at 1689. So that was just long a put. So in that trade, in that paper trade, we could look at, yeah, you could consider selling, and I already did go on in and take a peek at this. The Jets trade, we bought October 27th put option, and that has doubled. So we paid $1.10 for the 19 put, and it's now trading at 218. So I said to myself, well, maybe I want to sell another put against this and roll into a long put spread and give myself a little bit of downside on this. But guess what? Implied volatility just isn't really rocking that much now. And that 16 strike put that I might sell to give me a 3-point wide put spread is trading for 24 cents on the ask, 22 cents on the bid. I don't know if I really want to sell that. It's not a ton of premium to bring in. If I could sell something that would maybe cover my cost basis, which was $1.10 on this, I don't think so. So at this point in time, I would probably just sell my 19 strike put and get out of that trade and move on and take the double, right? We paid 110 for it, so a double would have been 220. So I don't think I would sell a short put to leg into a long put spread on Jets. I'd just get out of that trade. Then on the QQQs, we went in, and I'm highlighting it over here. QQQs were at 374. They're now at 361. And we bought a long put in that underlying. So we already talked about rolling that one into a long put spread. And I probably would have done that at that point in time. We're getting a little bit of a bounce back. Actually, it looks like the markets are starting to decide that maybe that was positive what happened over the weekend. Got the SPX up a little bit. And then obviously we got the VIX. Well, the other one was the SPX. And actually we did a butterfly that wanted the market to go to 42.85. And it's at 42.90 now. So we're only 5 points away from that. It was actually at 42.85 when the day begun. So it was a little bit lower. It already came back and is making a move to the upside. So that butterfly, if you didn't get out of it, you should definitely get out of it now. I don't remember what expiration. I think it had, we went out to October, so it still had some days to live. So it would be very possible to just get out of that trade today. All right. So if you have any questions about any of the trades and you want me to go into more detail, feel free to put it in the chat box on YouTube, and I'll be able to address them during the show. Whatever, Options Guy TV, we want it to be as interactive as possible. And you are a part of this show. Please share it with friends and family. Let people know about this. We want to get the word out about Options Guy TV, and just the whole show is about learning. If we take what's going on in a specific underlying, what strategy inside the options playbook might apply to that underlying stock at this specific time period. And so if I'm looking at that trade and I'm trying to decipher what strategy to use, there's not always the perfect strategy. I know a lot of people will go into the marketplace at the beginning of the year and say, all right, every 2 weeks or every 3 weeks, I'm going to do an iron condor in a large index. And there's nothing wrong with that trading strategy. That just would make for a very boring show if we came in on 3 days a week and just did an iron condor in one index. So a lot of the same things will apply, and we've already looked at an iron condor every once in a while, or a selling call spreads and selling put spreads, which really make up an iron condor. So that strategy is available, and we can talk about it from time to time, but your questions add to this show. So feel free to put them in the chat box on YouTube if you have anything that goes along with a lot of the themes that we were talking about here on the show. So if you want to do a rinse and repeat, and we're looking at about 45 days out. So that the one thing about kicking that can down the road, which is kind of nice, and I don't know if I'm pretty sure that Congress wasn't really considering this, but we get out of October, right? We get into a more happier time on the calendar for the marketplace, because it does seem that in September and October, bad news is received received in a more in a bad way, more so in September and October than it is in any other calendar month on the year. So if there's one thing to highlight about the 45-day kick the can down the road, is that we're now going to be into the holiday seasons. Maybe people just won't be paying as much attention if we get the bad news. But a government shutdown would be extremely bad for the economy, considering where we're teetering right now with interest rates at highs that we haven't seen in 10 years or so. All right. So if I want to get I would be more apt to continue the butterfly strategy. We talked about the butterfly and the SPX hitting our short strike on the butterfly, which would have made that trade, 100% you'd want to get out at this point in time. You still had a couple of weeks left in it, but I would get out because it actually hit our short strike today before the Options Guy TV took off. So I don't mind going out and maybe selling a call spread in something like the SPX. So I want to do something that is still centered. We still got some scariness in the marketplace a little bit, and I don't think the market's going to be able to take off until we get rid of these budget concerns. So we have a big event in November that's going to be the Fed meeting, but I want to sell some of this premium because now I'm on the other end. The VIX is staying fairly high, so I'm going to go out to mid-November, and I'm going to look at selling an SPY. We're going to get out of the SPX. We're just going to sell an SPY short call spread, something that is neutral to bearish. And I kind of expect to just see a little bit of chop in the marketplace until this gets figured out. The Fed right now is still saying there's only a 30% chance that they will raise interest rates. And if that is the case, and they don't raise interest rates, I do think that will be a positive for the marketplace. So if they do raise the interest rates, we still might get a muted move in the major indexes after that announcement. So let's go on out into November, and we're going to go just the beginning of November. We're going to look at about 32 days out. And we're going to be in the SPY now, November 3rd. Let's see. I'm going to pull up a calendar here and see what day of the week November 3rd is at. So that's a Friday. So I don't mind that one. Let's do the November 3rd, 32 days out. IV is trading around 15% on that. And we're going to go about a 1 standard deviation move out of the money. Market inside the option grid right now is showing 428.14. 1 standard deviation move is right around that 450 level. We're seeing it trading at $1 on that 450. I kind of want to bring that in. I wouldn't mind getting to the 451, but I'm not getting enough credit for it. So I'm going to sell the 450s. And then I'm going to go out and buy. If I go to the 455s, I can get 50 cents for that. And I'm going to buy the 455. So in this instance, this is the buy. There we go. Now we're bringing in a 52-cent net credit to the account. We are 1 standard deviation out of the money. We have $4.50. Well, we're going to call this, 52. We could fill it right at 52. So we have $4.48 of risk on this trade. And if I can buy this back for around a quarter, I'm going to look to do that. Anywhere from 20 to 15 cents net debit to close this trade off, I'm going to look to do that trade. On the upside, if I'm down about $1 on this trade, if it's trading somewhere close to 1, I'm going to look to get out of this trade. Anywhere, and some people will give a little bit of leeway, anywhere between $1 and $1.25. That's when I would look to get out of the trade. Higher probability of success by doing this trade, hoping that the markets just do a little bit of chopping. We start getting some time decay. Going out about 32 days in time, probably be out of this trade within 16 days or so, depending on where the market is at. But it's going to be a very simple paper trade. And based off of the fact that we did get this legislation that goes out 45 days, gives them 45 days to try to come up with a budget. Congress is them. I think that this is where the marketplace is going to stay. And you might even consider going on the other side of this trade and actually selling the put spread. That would make the iron condor. I think that we have a little bit more resistance to the upside in this marketplace. So I'm just going to sell this short call spread in the SPY. And that is going to be our paper trade for this Monday, Options Guide TV. And I'll make a screenshot of it. And if you have any questions, please feel free to put them in that chat box. And if not, which I don't see anything in there right now, and if not, well, thanks for coming today. Please click subscribe, ring that bell so you get all the updates for Options Guide TV, and pound that thumbs up. That actually helps us out too. And we'll see you this coming up Wednesday for the next edition of Options Guide TV. Thanks for coming, everyone.